You don't need a $1,000 trading course to make money in the market. Trust me, I learned to trade for free here on YouTube. So now I make a living trading. The only things that you really need are solid charting, a reliable strategy, and the discipline to execute it. Today, I'm breaking down one of the most important skills that made me a profitable trader, and that's charting support and resistance. This is the foundation of my trading, and I'm going to show you exactly how I do it. No fluff, no BS. Let's go. Futures contracts are about to roll, and I need to update my charts. So today I want to take you along while I chart support and resistance levels for what I trade most, the S&P 500. I chart the futures contracts because they have useful information from 23 hours of trading data, including how the global traders in Asia and Europe traded our markets. And I can use this same chart to trade ES or MES futures, SPX or SPY options, in really any S&P 500 ETF or derivative product, all from this one chart. Charting support and resistance levels is the foundation of my trading. With that prep work and analysis done ahead of time, I can focus on the most interesting and potentially the most profitable areas in the market, and then wait for the market to come to me, and then apply techniques like those I've shown in the entry and trade management strategy videos. I'll link the best ones for you. Charting these levels gives me perspective, knowing where the market has been and where it's likely to go again on a macro scale. Even though my intraday trading is nitpicking relatively small movements within these levels for profit, it helps keep me calm in my trades, knowing that I have a really good idea of where moves are likely to be made in the market, and then I can just wait for when. When price reaches a major level, it's either going to break, reject, or chop. And with a roadmap to the market through support and resistance charting, I just have to wait for those inevitable stops and ask mom and dad if I can go into the gas station for a snack. If I'm careful, I could end up with a ridiculously sized sweet drink and some candy or chips. But if I'm not, or the market, mom and dad just aren't having it, I could shoot my shot and miss. But by targeting areas where we can expect the major players to be hanging out, we can pick up those scraps that us retail day traders are after, and we can pick them up with an edge because these major levels of support and resistance are where we get the big reactions, where we can have a relatively tight stop to a high profit potential. So I'll dive in and show you exactly how I mark up my charts as well as how I manage them. And it all starts with my quarterly charting routine. My messy markup charts can get really messy in a hurry. And since I trade futures, I've gotten into a groove of refreshing my charts every quarter with the quarterly contract roll. By the time it's time to roll contracts, my charts tend to kind of look something crazy like this. I do go through and clean out levels from time to time, but I've admittedly been lazy this quarter because price has moved so far away from the levels that we were trading early in the quarter, so I've really just ignored them. This chart is especially dramatic, but this is what we don't want. So real quick, before we dive in too deeply, let me quickly go over what futures contracts are and make sure we're on the same page about why they roll in the first place. And this will help you understand my markup as well, so stay with me. A futures contract is essentially an agreement to buy or sell an asset at a predetermined price at a specified date in the future. In this case of the ES futures, these contracts track the S&P 500 index, and traders can speculate on or hedge against market movements. As day traders, we're not looking to take delivery of an actual ES contract. We use futures for the leverage, liquidity, and the ability to trade long and short really easily. So if someone were to actually purchase an ES contract and hold it to expiration, they'd be settling for a cash value equal to the S&P 500 index times $50 per contract. That's a lot. But since we're just in and out for quick intraday moves using discount futures broker margin, we're just here to capitalize on the price action, not take delivery of anything. We're just speculators in ES futures, not investors. Unlike stocks, futures have expiration dates, and you might be familiar with that if you're an options trader as well, but the ES contracts expire on a quarterly cycle. So that's March, June, September, and December, because they're designed for institutional hedging and speculation within set timeframes. So once a contract reaches expiration, it's invalid, which is why traders need to roll to the next active contract. This can mean closing out positions in the expiring contract and opening them in the next one. Or if you're a day trader, just switching your charts to the next contract. We follow liquidity so we can keep rolling with the big boys. Now, one thing traders notice during rollover is the price of the new contract usually differs from the old one. And this happens because futures contracts are priced based on expectations for the future, the date that it expires, and not just the current spot price. So there's factors like interest rates and overall market sentiment can cause a premium or a discount in the new contract. This is why you might see a gap between the expiring contract and the new one when you switch over. However, this difference is not indicating a change in the underlying market. It's just a normal part of how futures pricing works. Although it does tend to give newer traders a jump scare when they first open their charts on roll day for their provider. If you're trading ES futures, it's crucial to track when the roll happens. It's usually the Thursday before the expiration date, and we just call it roll day. That's when the volume shifts from the old contract to the new one. So volume shifts to the new contract and the old one is losing liquidity. You always want to trade the contract with the most volume to avoid slippage and unnecessary volatility with price jumping around. A good rule of thumb is to check where the highest volume is each morning leading up to the expiration. And once the new contract has more volume than the expiring one, it's time to make the switch. All right, now that we've covered that, let's get into the real reason you're here, finding those high probability support and resistance levels that can make you a more profitable trader. So now for the best part, let's chart. I chart all of my levels on the quarterly contract chart. So right now, the March contracts are expiring. So that's what my messy disaster chart is that we're abandoning. I load a 2-chart layout so that I can see the expiring contract as well as the new one, which is now June 2025. I sync the interval, time, and date so I can make these charts really easy to compare. The contract symbol follows the format ticker, quarter code, and year. So H is for March, June is M, September is U, and December is Z. These are part of a universal futures month code system set by the CME, and they use it across all kinds of different asset classes, including commodities, currencies, and of course, indexes. I keep the expiring and incoming contracts both on my watch list, along with SPX and XPY, so I can really quickly compare the different values. Platforms often offer a continuous contract where the current contract is placed in front and the previous contracts are blended with the current, either by adjusting the values or by leaving a gap. I personally like to keep my continuous chart completely clean, so I always have a clean chart to look at. With my levels saved to the quarterly contracts, it's really easy to keep the level clutter under control. It forces me to have the discipline to clean out my charts at least once a quarter. Although I really tend to do weekly checkups on Sunday nights or Monday mornings to clean out these levels and tidy everything up. So some of y'all are going to think I'm out of my mind, but trust the process. I start with my monthly chart. Right now, I have trend lines visible, but I have levels hidden on this monthly chart, and this is fine for now. Sometimes I'll hide the trend lines, but Any more noise than this can get really tough to look at. And of course, I got all of these from lower time frames, so they look really crazy on this higher time frame chart. So then I just literally mark where a lot of candle bodies and or wicks line up. This is showing where a large block of whales or BSDs have been doing their business. So we can tell because price has spent a lot of time at that level before it could be satisfied. Y'all know I love to play a good wick, and I'll mark those as well. On the monthly chart, this is where the very most major swing highs and lows are, and they're great areas to watch. If it's a really general level, I'll mark it with an M for monthly, and I try to stay really disciplined about making all of these notes on my chart because I'm going to be using these on much faster intraday charts when I'm actually trading, and it may not be obvious when we get to a major swing high or low that was put in months ago that that's what that is. So these notes really help me stay sane. So when I know a level's coming up, I can just focus on the trade and not everything else. Once I've gotten the areas around the current price action taken care of, I'll move down from the monthly to the weekly chart. And this is where I have the visibility on for my March contract, so it's going to get pretty crazy. On the June contract, we can see how these levels line up with the weekly swing highs and lows, as well as major areas where we get multiple touches. I know a lot of people have a lot of rules out there for how many touches and wicks and bodies and that sort of thing, but on a monthly chart where we just were, there will understandably be fewer touches on important levels than when we move down to these faster time frames. So the more I move down, the more touches I like. On the weekly chart, I'm just adding anything else that catches my eye. I love spots where price will wick up to a level while rising and then back down to the same level while falling. When I'm marking levels, I tend to use horizontal lines, and then when I'm marking wicks and swing highs, a lot of times I'll use a ray. And this isn't a huge deal. You can use horizontal lines for both, but if I don't end up making notes on a level or I don't have good notes anyway, it's easy for me to find out what was going on when I mark a swing high or a wick at its little endpoint. Then I can zoom out and see where it came from real quick. Probably a Barbie nuance, but maybe you'll find it helpful. Then I go down to the daily chart, which is one of my favorites, and the point when I start paying a lot of attention to the trend line. So when I plot them out on a weekly or a monthly, they're touched so infrequently that I tend to be kind of wasting my time. But on the daily, the shapes are a lot more obvious, and when I'm charting like this, it can be hard to get the angle right for my trend lines without the prior data. But what I do is I copy paste the trend line from my previous chart and line it up with the new contract, and then I can find where that trend line is supposed to be. Some of this mess is from lower time frames, especially the more turquoise and cyan lines, so I'm just kind of ignoring those. The daily is also where I start to look for confluence with other support and resistance strategies like Fibonacci. I mostly pay attention to the golden pocket between the 382 and the 618 with a focus on that midpoint, especially when the fibs line up with other wicks and structure. I'll mark those levels. If a daily level has confluence with a fib or other level, this could be a gap or from market profile or some market voodoo, whatever, I'll add a note of whatever that is. That way, I know that when we get there, it's going to be an important level to watch. In fact, once this contract does roll, I'll mark the gap between the new and the old contract. I don't see any other major gaps on this chart, but I always mark a full gap between prices. If it's just a little imbalance gap, I need to be more impressed or my chart will get messy real quick, so I'm a lot more picky about those. Since one side of this golden pocket isn't marked, I'll go ahead and add that. Since price action is nearing this level, I'll probably be playing this one soon. Since the values are different on the new versus the old contract, I marked the all-time high for both. On the new contract, I've marked out the all-time high as the adjusted all-time high because that's the highest value that this contract has traded. I also mark the value of the old contract's all-time high. The big guys love those. I noticed that this all-time high lines up with a monthly level, so I'm going to consolidate and favor that all-time high since it's a real number where the highest order was on that contract. Then I'm really just looking for anything else that I missed, like this trend line, which I know from when I first marked it is a big one on the continuous contract, connecting us all the way back to 2023. But I should have been a good girl and marked it. I'm also marking the fib extensions and the big swing low that we just put in. If these are at or near anything else, like this 5300 century figure, of course, I will make a note. And when we have something more abstract, like a Fibonacci extension and an actual level that actual price hit, I'll always favor those actual prices over the Fibonacci because I always default to reality. And of course, I didn't forget that low. They are easier to mark on the hourly, where I really like to dive in and mark any big areas of consolidation. I know that price action is really likely to be choppy and volatile on the small time frames in these areas because they're literally areas of indecision, which is what causes consolidation. If you've watched any of my breakout strategy videos, you know that this is an area that I'll be watching for a breakout, just like the one we're getting today. In fact, we have perfect examples of breakout entries, even on this hourly chart. Okay, at this point, I'm going to turn off chart syncing because we are done with that old chart. To manage my levels, I always create a folder to keep them all in. And then if I add any levels or ranges, I always add those drawings to this folder. This way I can really easily sync my levels across the platform and show or hide them really easily and quickly. All right, finally, I compare the new contract on my two favorite higher time frames, which is the daily and the hourly. Usually I have the continuous contract on the left, so I don't have all my levels show up, but when I'm doing this charting, I'll go ahead and put the monthly chart there. So the role for TradingView is tomorrow. So that's when TradingView will update to having this chart in front of their continuous chart. NinjaTrader has already rolled and I was trading the new contracts over there already today. However, I can change the visibility for the new group of drawings and then the problem is solved and it looks like my everyday chart here. Anyway, here I'm watching the 2 and 3 ATR Keltners on the daily along with the 21, 50, and 200 moving averages. And I like to pay attention to where these levels line up on the chart and if they have any confluence with anything else. Also, if I find a more minor level that I want to watch, I'll usually mark it in a secondary color, so just so I can easily differentiate in the heat of the moment. All right, I realized I had not marked the swing low from last month's contract, and that actual value from the expiring contract could come into play, not just where that swing low hit on the new contract. One last glance through the time frames to make sure I'm satisfied. Good Lord, look at that beautiful breakout. If you like any other levels, like market profile or Fireline's orphan levels, anything like that, these can be added as well. In fact, when I find confluence between support and resistance levels with any other level methodology like quants or profiles, I make note and that will be one of the most major levels that I'm watching for entry or exit. So look, if you take this support and resistance chart, maybe add some little intraday pivots and support and resistance as you go along, and add a price action based entry strategy or two. That is all you need from a technical standpoint. This is the easy part. The hard part is really managing the mush between your ears when it tries to complicate things and throw in some new untested plays and ideas at you when you're at the line of scrimmage in the heat of the moment and turn great ideas into shit executions. Guilty. Don't neglect the mental stuff, and trading really is as simple as marking levels and playing what you're given when price gets there. So do me a favor, Like, subscribe, share, and watch the next video, and I'll be back with more free game for you really soon. You can support my work by becoming a channel member or through my website at bullbarbie.com. And don't pay for a course. You don't need one. Everything you need is out here for free. I'm making sure of it. All right. Till next time. Love you. Bye.